The stock of the day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
And our stock of the day is G8 Education, early childhood education, care centres, more than 400 centres nationwide. Now, it says the expected increase in occupancy did not occur over this half of the calendar year. As a result, it expects 2025 earnings to be at a similar level compared with the previous year, sitting between $91 and $98 million. Spot occupancy in early November is down more than 6.5% from a year ago, and it points to affordability and cost of living pressures which continue to impact families. In addition to that softer occupancy, it has also flagged higher costs associated with changes to the regulatory issues, and has prompted RBC Capital Markets to express a negative sentiment for the company, with a broker having a $1.70 target price on the stock. Now, Rudi, you've got across this one. Yeah, what do you think?
I mean, the problem I have with some industries, and this is one of them, is that it's just the industry structure. There's so much you can dislike about it. Also the fact they have a few pedophile problems as well, and then of course the kids themselves, people who work there, not always qualified, underpaid, you name it, and then you get obviously the government must be seen in doing something, and plus they can't exist without government support. I mean, it's the same with the aged care and to be dependent on government support at a time when governments have problems with the budget is not a position to be in. Right? You see it on a different level. You see it with the likes of Ramsay Healthcare, private hospitals. Right? To a large extent, also dependent on what governments put in the coffer. Right? So there's lots of reasons to dislike this one and not to go there, and another reason why, given today's share price response and after another profit warning, yet another one, often share prices are cheap for a reason. Now, having said so, a lower share price on the assumption that they're not going to cut their dividends also creates a very high yield. And I know for certain there's people out there that's the only thing they care about. Now, in the long run, that probably doesn't necessarily always go down well. But you can make an argument that even if they have to cut their dividend, that you still get a high yield. So on that's the only basis I would personally think that you could possibly add that to your portfolio. But in general terms, I can't get excited. Even not on a higher share price, and even not at some stage when the metrics pick up. It's just not a sector I can get excited about.
If you've been in it, you wrote it down to these levels.
You have to punish yourself. Eat a whole bowl of mustard, I would say. The other thing is you can seek some solace in the fact that you will get the dividends.
So do I call it a hold? For those that are in it.
For those who are in it, yes, and enjoy the dividends. Because I'm assuming that's why you were in there in the first place.
All right, I call that a painful hold.
Yeah, the painful one. Yes.
All right, now Shawn, you didn't get this homework, so you're coming late to the party, but any particular observations?
I've got insight into the industry a little bit because my goddaughter works in childcare and she gets paid a pittance, as Rudi pointed out, and my wife services a few childcare centres as a landscape gardener, and I know they've got quite a bit of cash on the one-off level. And I think as a business, the small operators owning up 1, 2, 3, 4, 5 centres, buying a nice property and using it a bit like the McDonald's model, using the revenue to pay off the mortgage and suddenly owning up 5 properties as their superannuation fund. These guys I know are making a lot of money. But I think once you try and roll that map out of the big rich areas where people aren't worried about the cost of living pressures, and there are only so many suburbs that's the case, I think you hit big hurdles really, really quickly. The share price has halved this year. I see no reason to be in there at all. But on a micro level, you look at it and you think, well, they should be making a lot of money. It's so expensive to send kids there. the wages are awful, that's a great combination, but then I also don't like the fact that governments are involved. They can determine how much you make. That to me is a huge red flag or two. So I couldn't buy it.
Well, the recent negative news flow hasn't helped, has it?
No. Well, no, it can't. And, it's very bad negative news flow. But at the end of the day, I just think it's a difficult model to roll out exponentially across the country.
So no.
No.
All right, so that is a reluctant hold and a no as far as our stock of the day, G8 Education.
The stock of the day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at ig.com.